All right, today we're going to tackle something called IFRS 9. Now, it's a huge accounting standard that frankly reshaped how companies all over the world report their finances. It might sound a little dry, but trust me, its impact on global finance is massive, and we're going to break it all down.
I mean, just think about that for a second. We're talking about banks, massive corporations, insurance companies. They're all juggling these huge portfolios packed with loans, bonds, derivatives, literally trillions of dollars. So, how on earth do they keep track of it all in a way that's consistent, transparent, and makes sense to everyone?
Well, before 2018, the world had an older, creakier system. But after some, let's call them learning experiences in the financial world, there was a huge call for something better. A new rulebook was written, and that rulebook, IFRS 9, completely changed the game. So let's dive into what exactly changed and why it's so important.
So here's our game plan for today. First, we'll look at why IFRS 9 was even created. Then we'll get into its three main pillars: how it sorts financial instruments, how it makes companies predict future losses, which is huge, and how it deals with managing risk. And then we'll tie it all together with why this actually matters to all of us.
Okay, first up, the origin story. Because to really get IFRS 9, you have to understand what it replaced and maybe more importantly, why it needed replacing so badly. The whole thing was a massive philosophical shift, a move away from being reactive to being proactive.
So, the old rulebook was this thing called IAS 39, which goes all the way back to 2001. But after the 2008 financial crisis, regulators and investors basically said, we need a smarter, more forward-looking system. So, over about 5 years, IFRS 9 was built piece by piece, and on January 1st, 2018, it officially took over. And this, right here, is the heart of the change. The old system, IAS 39, used what's called an incurred loss model. That meant a bank could only account for a loss on a loan after the borrower was already in trouble. It was like waiting for the ship to actually hit the iceberg before you're allowed to sound the alarm. IFRS 9 flipped that completely on its head with the expected credit loss model. It forces companies to look forward, use all the data they have, and estimate the losses they expect to happen down the road.
Okay, so how does this whole thing actually work in practice? Well, it all kicks off with the first major pillar, a new, much more logical way of sorting or classifying all these financial assets. And how you classify something determines everything about how it's measured.
And what's so elegant about the new system is that instead of, a crazy web of complicated rules, it boils the entire process down to just two fundamental questions. Your answers to these two questions decide everything. Test number one is all about strategy. It asks, why do you own this thing? What's your business model for it? Are you just planning to hold on to it and collect the payments, like a simple loan? Or is your plan a bit of both? You'll collect payments, but you might also sell it if a good opportunity comes along. Or is it really just in your portfolio for active trading?
Right. Once you've figured out your strategy, the why, IFRS 9 asks a second question. But this time, it's about the nature of the asset itself. This is called the SPPI test. It's a bit of a mouthful, I know, but the idea is actually super simple. It's asking, do the payments from this asset look and act like a plain old loan? Are they solely payments of principal and interest? Or is there something more complex going on, like payments that are tied to the price of oil or a company's stock performance? And boom, here's where it all clicks into place. The answers to those two tests automatically drop every single asset into one of three buckets. If you're just holding to collect payments and it's a simple loan-like asset, it goes into amortized cost. If you're holding to collect and sell, it lands in fair value through other comprehensive income, or FVOCI. And finally, if you're mostly trading it or it has weird cash flows, it goes into the third bucket, fair value through profit or loss, or FVTL. And this one's a big deal, because every little tick up or down in its market price hits the company's profits directly.
Okay, let's move on to the second pillar, and honestly, this is the real game changer in IFRS 9 impairment. This is where that whole proactive, look into the future philosophy really comes to life.
So at the very core of this is the idea of expected credit losses, or ECL. And it's not just some wild guess. The standard is very clear. It has to be a probability-weighted amount. That means companies have to think about a whole range of future outcomes, the good, the bad, and the ugly. Figure out how likely each one is, and then calculate the potential loss. It's sophisticated stuff.
And to make this happen, IFRS 9 sets up a three-stage model. So imagine a brand new loan. It starts out healthy in stage 1. The company just has to set aside a small provision for any losses it might expect in the next 12 months. But if that loan's credit risk goes up significantly, it gets moved to stage 2. And now all of a sudden, the company has to recognize a provision for all expected losses over the loan's entire life. That's a huge jump. Stage 3 is for when things are actually bad and the loan is considered impaired.
So how do you know if credit risk has increased significantly? Well, IFRS 9 gives some guidance, but it also includes this really practical backstop. There's a rebuttable presumption, basically a strong suggestion, that if a payment is more than 30 days late, you've got a problem. Now, a company can try to argue and say, no, everything's fine, but they'd better have some really solid proof. It's a clear red flag.
All right, on to our third and final pillar, hedge accounting. This part of the standard got a major facelift to make it line up better with how businesses actually manage their financial risks out in the real world.
Look, hedge accounting can get super technical fast, but the absolute easiest way to think about it is like this. It's basically financial insurance. A company is worried about big swings in things like interest rates or foreign currency values or commodity prices. Hedging is the strategy they use to protect themselves, and hedge accounting is just the set of rules that lets their financial statements reflect that strategy.
IFRS 9 really hones in on two main types. A fair value hedge protects the value of something you already own. So for instance, if you own a bond and you're worried rising interest rates will tank its value, you'd use a fair value hedge. On the other hand, a cash flow hedge protects you from uncertainty in the future. So if your company knows it has to buy supplies from Europe in 6 months, you could use a cash flow hedge to lock in that exchange rate today.
Okay, so we've walked through the three big pieces: classification, impairment, and hedging. But let's zoom out for a second. What's the big picture here? Why should we really care about what seems like a pretty complex accounting standard? When you boil it all down, IFRS 9 drove three massive, crucial shifts. First, we got a much smarter, more logical way to sort financial instruments. Second, and this is the big one, we got that proactive impairment model, forcing losses to be recognized way earlier, hopefully creating a bigger buffer against financial shocks. And third, we got hedging rules that finally match up with what businesses are actually doing. And in the end, don't just take my word for it. The standard itself says its goal is all about giving investors and everyone else who reads these reports more relevant and useful information. It's about helping people understand a company's future cash flows, the amounts, the timing, and the uncertainty. It's about transparency. Which brings us to one last big question to chew on. The whole point of IFRS 9 was to make the financial system more stable by forcing everyone to look into the future and plan for losses. But did it actually work? Did we make finance more resilient? Or did we just swap one set of problems for another by adding layers of complexity and judgment? That's the billion-dollar question.